All right, so when we have foreign exchange risk, whether we have a receivable or a payable that is in another currency from our own currency, right, we have the options of being able to hedge that exposure or not hedge, right? That's what we've generally been talking about. We leave it unhedged or we hedge it. But there's a whole huge range of things that we can do in the middle. So what we're discussing today is we're going over the concept of a 50% hedge, right? How we hedge half of our exposure. Okay, we're going to do this by looking at a single account receivable, right? Let's say that we have a 4 million euro account receivable exposure. Okay, which that means essentially that we are long on the euro, right? And we're assuming this is our only foreign exchange risk that we have. We have an account receivable. Somebody's going to be paying us 4 million euros in 60 days, and I need to make sure that I can hedge this exposure. Okay, so one thing that we know we could do is that we could go out and we could buy a forward, a future, all right, we could lock in the total amount. The other thing that we could do is that we can use options, okay? So what we're looking at here is that let's say that our spot rate, okay, is going to be $1.20 is equal to 1 euro, okay? So what we're looking at here is that is our exchange rate, and what we could do is that we could lock this in by using a forward, right? And so what we could do is we were locking it 100% hedge, okay? And then let's say our forward rate is the same exact amount as our spot rate, okay? If we're at 100% hedge, what we could do is we could sell 4 million euros forward, right? Because I'm going to be receiving euro, right? The company that I sold to is giving me 4 million euro. So I can take that euro and then I can sell them in the forward market. In the 60-day forward market, I can sell those euros and I can get dollars in exchange. Okay, so if I did that, I would sell 4 million euro forward. That would be 100% hedge, and they have no fluctuations whatsoever. It doesn't matter what the spot rate is in 60 days. I'm going to get it at $1.20, okay? So that is one way. That's how we could do a 100% hedge. Now, if we're going to be looking at this as a 50% hedge, how much do you think we're going to be selling forward, right? If we're using the forward market, we are going to sell forward. We're going to sell euro forward, but how much? We're only going to sell 50% of our exposure forward, right? So we're going to sell 2 million forward, right? We're only selling half of our exposure, right? Because what we're saying is that in this first case is that if the value goes to say 1.1, right, it loses value, is that it's not going to affect me at that 100% hedge, right? I have everything locked in. Now, if the change happens down here under a 50% hedge, is that half of my receivable is not going to fluctuate. I have half of it locked in. The other half is going to fluctuate a little bit, okay? So the thing that we've looked at is said, all right, if a company has expectations of fluctuations of volatility in that market and they can't take risks, then they'll hedge it, right? Or then we have other ones that can handle risk and they're just say, we're just going to let it ride. There's a whole huge range in there, and then a manager is going to evaluate basically a cost-benefit analysis, right? They're going to say, all right, what is the cost of the hedge? It's going to be, what is the cost to hedge? And then it's going to say, all right, if there's a certain cost that I have to hedge here, what am I going to do exactly? Okay, and I'm going to compare this to basically what I can tolerate with volatility. So we might say, oh, we can only do that. And this is something that's fairly common. Okay, another way that we can do this with a 50% hedge is that we can still look at this and let's say we still have the 4 million account receivable. Okay, so we have 4 million euros coming in account receivable. If we're going to use this as an option strategy, is that what we're going to do is that let's say we are going to hedge 50%, and let's say that our premium, right, per euro is 5 cents. Okay, so if we are setting this up and we're looking at our options, is that we are long on the euro, and a couple of ways that we could hedge this, right, is that we could sell a call, right? Right, that's one such way. Let's say that we have a strike of, so spot is at 120. Let's say that our strike is at 118, and our premium amount is at 5 cents. So we know that break even is at 123. Okay, so what we're looking at here is that this, right, this would assume we could have done this at 100% hedge. Okay, and we could have bought an option, right, on every single one of those euros that we're going to be getting. Okay, that's one way we could have done it. The other way is that we can come down here and we could do this as a 50% hedge. Okay, so what we know is that if we are unhedged, so we're going to look at the underlying. Okay, on the underlying is that we have here is that if the price were to go down to say 116, let's say the price went down to 116, right? From 120. Okay, so we went from 120 down to 116. Okay, is that the underlying, okay, is that we would have lost here essentially 4 cents. Okay, so the amount that we would have received is going to be the 116 multiplied by the 4 million, right? Which means that we're at $4.64 million. Okay, if it expired at the original amount, so that'd be 4 million times 1.2, it would have been, so if it expired at 120, the underlying would have been at $4.8 million. Instead, now we're going to get $4.64 million. But then we have to look at what we were actually receiving, okay, on the what our gain is, right? Because if the underlying loses value, I'm going to be making money on the option that is hedging it, right? Which is this amount right here. So I'm doing a 50% hedge. So when I'm saying a 50% hedge, that means, and I'm not buying 4 million euros worth of options on it. That means I'm buying how much in options on that? That means I'm only buying 2 million euro worth of options on that underlying, okay? Because I'm letting it fluctuate a little bit, okay? So what we have here is that on 2 million, okay, is that what is my profit or loss going to be if this expires at 116 on that option? Does this option get exercised? No, it does not, because the price is lower than the strike price. Remember, I sold this call, right? So this option does not get exercised. Somebody's not going to buy this for me for 118 when they can buy it on the market for 116, right? So the option is unexpired, okay? And so that means that we have a 5-cent gain. So we have on a 50% hedge is that we're only hedging then on 2 million euro, okay? And so that means that if we expire at 116, okay, that means that we are not exercised, all right? And that means that we will have a gain of the 5-cent premium, okay? But we're only hedged here on the 2 million euro, right? So we're only multiplying that by the 2 million euro on the, rather than on a total of 4 million, right? Which means here that we have a $100,000 gain, okay? Rather than if it was on the 4 million, we would have had a $200,000 gain. But we have a $100,000 gain on that option, okay? So on the end, on our net here, is that we have on the underlying, right, is that we actually ended up receiving $4.64 million, plus then we're also having our hedge, the amount that we received on that option, in the amount of 0.1 million, right? And so that means that our net payout here is going to be $4.74 million, which is really not all that far away from the amount that we would have gotten if it expired at the spot price at the beginning. Okay, but we hedged this, and we only hedged 50% of the amount outstanding, which is something that we can definitely do, and it definitely works out. Okay.